our company is wrong on about 45% of our trades. If we put on 100 trades, I know that 45 of those trades will be liquidated at a loss. Well, leverage can work for you, but leverage can absolutely kill you as well. Investors need to understand that you don't do investing and speculating with the same account. People become spoiled by profits that came from Bitcoin. It's a one-off. It's all of crypto is. It's something that's kind of taken place once in my lifetime, but only once in my lifetime so far.
Bienvenue sur Les Investisseurs 4.0, le podcast qui explore les stratégies et les méthodes pour développer son patrimoine immobilier quand on a 40 ans, un job à plein temps et une vie de famille trépidante. Quand on voit le niveau de volatilité des marchés et l'accès toujours plus facile au trading au travers de plateformes, on se dit qu'il y a de belles opportunités pour créer du capital avec le trading, mais c'est une activité à haut risque sur laquelle peu de gens gagnent de l'argent, encore moins de façon indépendante et encore moins au travers de plusieurs cycles économiques. C'est justement l'expérience de Peter Brandt, notre invité du jour, qui lui a passé les 5 dernières décennies à trader de manière indépendante sur les marchés matières premières et forex et affiche à ce jour un retour sur investissement annualisé de plus de 40% par an. Alors, comment est-ce qu'il s'y est pris et quels sont les enseignements qu'il en a tirés? C'est ce qu'on va découvrir aujourd'hui. Au cours de la conversation, on verra entre autres comment gérer son risque et découvrir le type de trader que l'on est réellement. Est-ce que c'est plus facile de trader, de vivre du trading aujourd'hui que ça l'était auparavant? Est-ce qu'il y a un quelconque avantage à trader pour compte propre face aux grosses institutions financières sur les mêmes marchés? Quelle est la différence entre trader et investir? Comment gérer la solitude aussi du trader indépendant et rester maître de ses émotions? Un témoignage très riche que je suis vraiment heureux de partager avec toi aujourd'hui. J'espère que tu apprécieras la qualité de l'intervenant du jour. Et j'en profite pour remercier chaleureusement Fabien pour sa suggestion et la mise en relation qui a permis à cet épisode d'exister. On démarre juste après ces quelques mots pour nos amis anglophones. If you're joining us for the first time, welcome to the show. This podcast is based in France and is about helping midlife busy professionals with family responsibilities, find financial security, and a sense of abundance through sound financial investments and smart personal development hacks. Today we have the privilege to talk to legendary trader Peter Brandt for a masterclass about market trading on your own account. We discussed the approach towards leverage and risk management, the difference between investing and trading, how to deal with losses in your day-to-day trading activity, how trading has evolved through the years and whether or not one can still make a living off trading today, and much more. Peter has traded for almost 50 years, which brings unparalleled breadth and experience to our conversation and to what trading can and cannot do for you. Peter certainly has a way to share his experience in an open manner, very honest way, which make you feel and really live the situation that he describes. I hope that you enjoyed this episode as much as I enjoyed my conversation with Peter today. If you do, please consider supporting us through leaving a review on Apple Podcasts, Spotify, or on the YouTube channel, or sharing through socials the episode as well. You'll find the link in the show notes. Okay, let's dive in our conversation with Peter Brandt.
Awesome. I was thrilled when I found out my book was translated in French. I just, because I didn't know it for a while.
All right.
I did not. And somebody posted on Twitter a copy of the book, the French translation of the book. I go, they're supposed to be sent to me. I mean, that's the arrangement that I have with the U.S. publishers. Whenever it gets translated, that, I get 3 copies and they let me know. And so it gets translated into French. And I go, boy, that's one I didn't know about. And so I was really pleased about it because I love France. A lot of U.S. people have mixed feelings about France. That's the truth. They think French are a little bit with their nose in the air, at least toward the Americans, which deservedly, right? Deservedly, Americans have a bad rap internationally, and they deserve it. They're loud, they're obnoxious, they're, and so to a certain degree, but I just have always had such fabulous experiences traveling in France. I was a big biker when I was younger, not so much anymore because of a really bad injury that I had in an accident. I don't bike the same way I used to bike. I used to road bike. I used to race, and so I've been over to France for the Tour de France. I've several times. I've gotten to know France primarily, through travels connected to the Tour de France, and I've come to really love French people. So that was thrilled when I found out my book was translated into French. I just thought that was absolutely wonderful.
And that's what's so wonderful about a subject like this as well, is that it's very universal. And as much as we could be have different cultures, you just pointed out, in terms of how we perceive each other, Americans, Europeans, French, there are things that are more essential and universal, and in particular maybe our relationship with markets and finance is something that maybe is more of a commonality than anything else, right?
Yeah, last year the book was translated into Vietnamese and Korean.
Oh, whoa.
and so every year I get surprised by what it gets translated into. Who would know that I have a following of people in Vietnam but actually Vietnam has become a pretty economically progressive country. I mean, it has it has a population of people who love markets, and so wherever people love markets and love price discovery, that's for me. So yeah, we've been translated into a lot of languages, but I've got to tell you that if I rank order, it'd be probably U.S. and then the French translation. So.
So that's great.
So it's great to be with you. Great to chat with you about all things trading.
No, absolutely. And thank you very much for being here. And the idea that I submitted to you and you were gracious enough to accept it is really to also pass on the message to the French audience, people who are increasingly, getting more involved in building themselves, their wealth and their financial stability, security, which, we're coming from a very long way in France, with a lot of advisors taking over in terms of market share, and we used to just rely on the banker and not take care of, our finances. And more, because of, obviously, the sharing of information, there's been more and more a need or an interest in all things investments. And obviously one of them, which is the one that probably feels the less accessible, is about financial markets and trading, which seems really, really complicated. Suffers also a kind of a bad rap, I would say. And so I'm really thrilled to really be discussing with someone who has so much experience in the field, not just teaching, but really doing the thing. So thank you very much for being here, Ray.
Yeah, well, and, futures are my area. I entered the business through the grain markets at the Chicago Board of Trade, and that was my entree. And, I do dabble with kind of the conventional stocks or interest-bearing instruments, government bonds, and so forth. But really, my first love and my focus is futures. And, of course, there's some, coming out of the Paris Motif Exchange, some of the great markets I love to trade. I have traded a considerable amount of the European grains, of your rapeseed contract, your wheat contract, and then the Motif corn contract. In the last couple of years, they've probably been as rewarding as any markets that I've traded. When I look at my profits over the last 2 years, they're kind of concentrated in U.S. grains, in European grains, and probably in the European softs, London cocoa. And here's the interesting thing, despite the fact that perhaps European speculators are a little bit further along the curve than French speculators. although that's arguable. Even though we have huge volume in European grain markets, I've found that the trends are more easy to trade. They're steadier. And I think it's because when we deal with the old motif exchange markets, there's a heavier concentration of commercial interests and not as much of a following from speculators who tend to chase markets and then get scared out of markets. And you get the large volatility that comes in from the speculative public, where European grain markets tend to be more heavily concentrated to commercial interests, users and producers. And I think that gives the European grain markets a much better time at having trends that are sustained and not erratic, and prices tend to trend in a direction much better, which is one of the reasons I've really become very attracted over the years to trading the European grain markets. Is they act better. They're easier to stay in a position for a longer period of time. But yeah, futures trading, of course, has exploded. Really in all countries. The Chinese futures markets, which are difficult for foreigners to trade because of moving money in and out of the exchange, and especially if you're profitable in the Chinese markets, moving money back out. They've made it kind of complicated, but their volumes are even much more substantial than the U.S. markets. And I got into the business through Continental Grain Company, owned by Michel Fribourg, a French citizen. So, Continental Grain was a French-owned company.
Oh.
And so, I owe the beginnings of my trading to the Fribourg family and Continental Grain.
That's really nice to know. I didn't know that. That's interesting. And so you'd say you have, because you have, you're very known for your career as a proprietary trader for futures, commodities, and forex, essentially.
Yeah.
Is there a particular, beyond what you just described, a particular a reason why you chosen throughout the years, right? Because one might think, there was a lot of volatility at the time when you started in 76 and not so much afterwards, but you've stuck to really that kind of support of asset type. Is there any particular reason why you think you were attracted to those things?
Yeah, I mean, part of that, Paco, is, that's how I got in business. I mean, that was my entree into the business, was the Board of Trade. And so I have, predisposition to futures markets. And so I don't think I fully appreciated the benefits of trading futures early on as I have now, when I can look back with some clarity as to really the benefits of futures markets. But I think it's an outstanding asset class for a number of reasons. In the case of the United States tax law, I'm an active trader, and the profits that would come from active trading, or what we would call short-term trading in the U.S., for me, are taxable at a 40% rate. And so, if I make $100,000 in a particular trading period in the U.S., I'm taxed short-term at the rate of 40%. Well, in the U.S. tax law was restructured a number of years ago so that all futures trading, whether it's short-term or long-term, is taxed 60% at the long-term rate, which is 20%, and 40% at the short-term rate, which again is, for me, 40%. So there's a great tax benefit for me as a U.S. citizen to take my profits in futures markets as opposed to stocks or bonds. The other reason, I think, is that they're 24/7 markets, or 24/5. Let's say they open Sunday afternoon for me at 4 o'clock in the afternoon, and they're traded continuously until Friday afternoon at 4 p.m. And where the stock market has much more limited hours, although there's aftermarket hours in U.S. stocks. They're very thin, where future markets and especially forex markets are traded pretty much around the clock. And then I think a big benefit for me, of course, is liquidity. They're very liquid markets, a huge volume in markets such as crude oil, gold, treasury bonds, the stock indexes are around the world. And I think another benefit for me is diversification. You know, if I'm a stock trader and I'm trading primarily London Stock Exchange, I'm trading the U.S. stock exchanges, and I have my money pretty well committed, when things get volatile, it seems like it's all one market. I have really no diversification. The correlation between, if I have 10 different positions on in equities, the correlation is high. And so if something happens with the Federal Reserve or an announcement or economic situation, while there's some independent moves that take place within a portfolio of, let's say, 10 holdings, they're pretty much correlated. Where in futures, you know, I can be long the Nikkei Dow, I can be short Dow futures, I can be long European corn, I can be short Mexican peso. I can have this hodgepodge of holdings that would be metals and grains and interest rates and stock indexes and sugar and cocoa and tapioca. And, and so it's a very balanced portfolio. I can be extremely diversified, both on the long and short side, across continents, across the type of commodity. That for me is a real benefit. And but I think the final thing for me is leverage. I love leveraged markets, and in the case of futures, usually if I trade a contract corn, which is 5,000 bushels at a price of, let's say, $5 a bushel, and so we have a contract that has an underlying value of $25,000. I'm only required to put up 5% of that to hold that position, because I'm not actually trading corn. I'm trading the promise to take delivery of corn at a later date. 99% of the trades in futures contracts are liquidated before the delivery process, and delivery is really not something I do. And so, you can make leverage work for you. The thing that I think the big mistake that a lot of novices to futures markets make, Paco, is they get fully leveraged up. They take too big a position, and these too large positions will kill them. And so I have the ability to really, let's say, acting in the capacity of a chief financial officer rather than a chief executive officer or a corporate treasurer. I have great control over the capital of the company, because at any given time, at most 15 to 20% of our assets are really committed to margin, but yet we can hold 2x or 3x the underlying value of the commodities of our entire capital base. And so I have the ability then to move that additional money into treasury bills. I can search the world for the highest percentage return on short-term rates and so forth. So I have great flexibility because I'm trading leveraged markets. I love leveraged markets. Leveraged markets will kill you, but leveraged markets can also be to your benefits. So,
yeah.
And then they chart well. I'm a chartist primarily. That's what I do. I don't look at myself as a trader as much as I look at myself as primarily a chartist. I'm a classical chartist. I'm a chartist in the classical sense, which brings my roots back to Richard W. Schaubacher's book from 1934, the Edwards and McGee book from 1948. And these are the people who laid out some of the basic principles of looking at a chart, of reading a chart, of understanding price action by plotting prices on a graph. And then I look at myself primarily as a risk manager, more than a speculator. My job is to manage my risk. My job is to control my risk. My job is to protect the money that we have available to trade. So that's really my focus, is how do I control my risk? How do I reduce my risk? Knowing that I'm a risk taker by nature and our job is to take risk, but how do we find ways to control that risk, to dampen the volatility?
Absolutely, and that's something that's really attracted me when reading your book as well, is the fact that you put so much emphasis on risk management, and to your earlier point about leverage, I completely understand. I think the advantage of first, creating the capital, moving more capital than your actual capital could do. I guess also there is an argument of being more liquid and diversification as well. If you think about it, you get more lines, different lines in different positions. But the downside of it is obviously there is more risk attached to using leverage, right? And so that's why probably risk management is even more of a prerogative, right, for this kind of approach, I guess.
Oh, leverage can work for you, but leverage can absolutely kill you as well. So we're always conscious of the risks that we have with our company's money. Yeah, we're extremely conscious of that. That's data that we look at every day. That if every position we had goes against us, what are we talking about in terms of loss? And so we kind of focus more on avoiding risk as opposed to, let's say, making money. I think a lot of novices who come into futures trading, their focus is, how do I make money? How do I make money quickly? How do I make the maximum amount of money? Where I think we've found that our focus is, if we can control our risk, if we can keep our capital together, if we can protect our capital, we'll let the profits take care of themselves, because they will. And part of that for us is, when I came into the business, and you'd ask the old timers, and keep in mind, coming into the exchange in 1975, you had traders who served in World War II in Europe. And they were still in their 50s at that point when I came in. So there was a lot of traders that were really born in the 1920s when I joined the business. And, if you'd ask them, what's the most important thing, trading principle, it was always cut your losses short, let your profits run. In other words, if you have a loss in a trade, you want it. You don't be afraid to take it. And as a matter of fact, it's mandatory to take it. You don't let losing trades dig too far into your pocket, because there are really two aspects to a trade, Paco, when you think about it. It's direction. Am I right on my direction? Then am I right on my timing? I might be wrong on my direction. I might think that gold is going up, but in fact, gold is going down. So in that case, I'd be wrong on my direction. And then it's timing. Is my timing to do this trade right? And I maybe want to own gold, but maybe now is not the time. Maybe the time to own gold is in the third quarter of 2024. I don't know. And so I think that was really something that was drilled into me by old timers, by the guys with gray hair. Is you want to get out of losers quickly, and if you have a profit, you want to try to be as patient with that trade as possible, even if it means that it's a trade that's profitable for a while and then reverses and goes against you. You want to give it that opportunity to have some ability to run a little bit. And then I think the other thing that was drilled into me by wise people was you may think you know where a market's going. You may absolutely be positive you understand the market and know where a market's going, but in the final analysis, you really don't have a clue. You just don't know. And so you go in and you do your best to be right and take a shot at a trade, but you don't want to become dogmatic. You don't want to become overconfident, because if you're overconfident, that's where the loss is, because trading is a marathon. It's not a sprint. It's, we're running a marathon. I mean, I've been doing this now for 49 years almost, so I've been a trader for 48 years. And so, rather than coming in and, people have become spoiled by profits that came from Bitcoin. Bitcoin's it's a one-off. It's all of crypto is. It's something that's kind of taken place once in my lifetime, but only once in my lifetime so far.
Yeah.
But it's building profits over a period of time. It's compounding. The wealth in trading comes from compounding. It's from doing 15% one year and 35% the next year. It's not from running 100,000 into 2 million in a year. It's from building steady, protecting your capital base. It's by prolonged profitability over multiple years. I know some traders. Bruce Kovnar is an example, probably the best trader that I personally know. Bruce hasn't had a losing year. Bruce is profitable every year.
Wow.
Not huge profits, but he's profitable every year. We've been wrong as a company. We've had losses in 4 years. So I can't say that. I can't say I've traded 48 years and I've been profitable every year. I can say I've traded since 1975, and we have 4 losing years, but the average of those 4 losing years is like minus 6%. The worst year we had was minus 13%. And so if someone's interested in, kind of hot money, they want to make money fast, they want to grow a small amount into a huge amount fast, I mean, good luck. There's been a lot of research studies, Paco, on how profitable independent speculators are in the forex market. The futures market is not a pretty picture.
I imagine. I imagine very much. What would you say is the percentage of traders on the market who can sustain a business out of trading?
Well, I think it's for sure less than 5%. The Singapore Exchange did a big research study. Hong Kong did a big study. There's been information that's come out of U.S. exchanges, U.S. forex. There was an Australian research firm that did a lot of research on forex traders, thousands of research of forex traders. And I think they found that it's, if you look at somebody depositing money, then after a year, after 2 years, do they have more money than they started with? And that's less than 20%. But then if you look at somebody coming in, let's say they want to be a speculator, they want to take some set of money, and they think, I want to be a trader. That's what I want to do for my life, is I want to trade. I want to live off my profits. It's less than 5%, and depending on the studies, it's as low as 2%. And so it's a steep hill to climb. But yet there are a lot of people on social media who advertise they can train traders and they have the secret sauce, and they have the magic, and they can transfer that magic. They can teach that magic, and if only you pay them $5,000, they'll send you a set of video cassettes that are guaranteed to make you a millionaire in a year or two, And so I think for somebody coming in and thinking that they either want to be a trader full-time, or let's say they have a good job. They're an engineer, they're a physician, a truck driver, whatever the case may be. They have a profession and they're comfortable with their profession. But, they have an amount of money that they think they want to manage themselves. And the way they want to manage it is in stocks or leveraged markets like forex and futures. And they don't want to do it full time, but they just want to do it as an adjunct to their income. They think, I can beat what passive investment will do. I can beat what my bank can do. I can beat what my wealth manager can do. And they want to give that a try. I think that those are the people that I think really have to know that it takes time. They have to be patient with it. They want to avoid day trading. They want to be position traders. Now, what does that mean? That in futures, that doesn't. In stocks, that mean that you buy a company and you hold it for years. Yeah. You don't do that in futures or forex. For me, our company is wrong on about 45% of our trades. If we put on 100 trades, I know that 45 of those trades will be liquidated at a loss, and 55% of those trades will be liquidated as a profit. That our losing trades will be held typically for an average of 3 or 4 days, and that our profitable trades will typically be held for 2 to 3 weeks, with some of them held 2 to 3 months. And I know that the thing that I guess I want to communicate to your audience a concept, which I just think people who make money in speculating, and that's what Warren Buffett is not a speculator. He's an investor. So if you want to think of yourself as an investor, think of Warren Buffett. He buys an entire companies, and he holds them for years. That's what investors do. Or they'll buy a stock in IBM or Apple. And my son is an investor. It's 2023, and he owns Apple stock that he bought in 1995. That's an investor.
A good investor.
And so, if somebody is buying something for long-term growth of the company, or for, in the case of dividends, they want the dividends, that's investing. If they're buying something to profit from price change, if you're buying something at X, you're selling something at Y, and your purpose is to profit from the price change from X to Y, that's a speculator. That's not an investor. That's a speculator. It's a trader. And so if somebody is coming in to trade, I would challenge them with a concept that I think is so crucial to understand, and it comes from an 18th century economist, philosopher from Italy, Vilfredo Pareto. And your audience may be aware of the Pareto principle, that 20% of events produce 80% of outcome, that 20% of people in a company produce 80% of the results, that 20% of volunteers for a cause produce 80% of the good stuff. And I've always challenged traders to take a look at all of their trading, and they will find that 20% of their trades produced 80%, at least 80% of their profits. And just about every trader I know who's a full-time professional trader or speculator will find that 10, 15, 20% of their trades over the course of any given year or over the course of their career will produce 80, 90, 100% of their profits. I've had years when 10% of the trades equaled 100% of my profits. But typically, 15% of my trades produce 85% of my profits. So then the question becomes, how do you manage that 15%? And how do you keep the other 85% from wiping out the profits of the 15%? And if a person coming into looking at speculating as either a full-time or part-time endeavor can figure out and embrace the Pareto principle in their trading, they have a strong chance of becoming the 5% of people who can actually make somewhat of a full-time career or part-time hobby become profitable.
Wow. So yeah, I mean, then it circles back to what you were saying about risk management in that way, because the 80% of your trade is a lot of your trades that you need to just consider that it's okay. They end up with a loss, which psychologically is kind of difficult to admit, I would say. And in practical terms, how do you, what's the level of trade that you find of losses that you find acceptable? The point up to, okay, I've cut my losses, or I put a stop loss, and that's it.
Yep. It's just a great question, Paco. That's a wonderful question. You know, as a firm in our capital, when we enter a trade, an example is last week we bought London sugar. We bought this, and that's traded in Europe. And typical of any trade we do, we risk somewhere between 0.5% and 1% of our total capital. So let's say we're trading a $2 million block of money. That's the capital our firm will trade in our markets. You know, that means that our typical risk on that $2 million will be $10,000. That if we lose $10,000 on that trade, we're out. And we have trading guidelines that we go by, that we've developed over the years. And, you know, you pointed out people don't like losing money in trades. I mean, I think that's the big problem is people invest their ego in trades. You know, they don't want to take a loss because somehow in the process of taking a loss, it reflects upon their intellectual ability or their emotional fortitude. They take a trade personally. Well, you know, if you look at crude oil futures, the crude oil futures don't know who I am. They don't know who you are. They could care less, Paco, about you or I. And so why would I take a loss in crude oil futures personally? Crude oil doesn't take me personally. And so we just assume that our going in default expectation as a firm for a trade is that we're going to lose money. Now, even though we have a slightly better than 50% win rate is what we would call it, you know, let's just assume it's 50%, or let's just assume over a period of time we're only right 40% of the time. Then it's proper for us to have a default expectation that the next trade that we do in the series of trades that we're going to do is going to be a trade that produces a loss for us. And so if we can emotionally, intellectually just assume that that's the case. I mean, you think of the game of baseball, the game of American baseball, where if somebody is successful in getting a hit 30% of the time, they're an all-star. They're going to make the all-star team. They're going to be paid $20 million a year to play in their contract. Or you think of European soccer or world soccer. We call it football. Our game of football is not football. Your game of football is football. But you think of the number of shots that are made on goal in soccer. It's just a tiny percentage of offensive attacks produce a goal. It is not uncommon for a soccer game to end up with a score of 1-0 or 3-1. And so you have to take the same mentality in trading. Is the markets they don't take you personally. European sugar doesn't know who I am. And so if I lose money, it's just part of the process. And so we just think that losing is part of the process of winning, that we must lose to discover winning trades. We must go through, we must, in the process of 100 trades, we must go through all 100 trades to find the 15% of the trades that will produce our net bottom line. And so thinking of it this way, Paco, if we used to get from our broker a printout, a one-page printout for every trade we did, as we bought cocoa, we sold cocoa, and so we call them P&S statements, P&L statements. And if we take every P&L statement we've ever done as a firm and we put them in a stack, let's say that stack of paper goes from the floor to the 10-foot ceiling in our office. And now let's say we know exactly how much we have made as a firm during the life of the firm. We know that number. As a number we know. We know it to, plus or minus a few $1,000. And so we take that number and say, we're going to pull out sheets of paper that equal that. We're going to start with the largest profit, and then we're going to sequentially go down to the next largest profit. And we're going to pull out sheets of paper until we have a number of sheets of paper which is the same number as our total profit life of existence of our firm. We end up with a stack of paper that's a foot tall, or maybe a foot and a half tall, 18 inches.
Yeah.
That's how we end up with.
Wow.
And so it's really in the process. And I have challenged other traders who are professional traders, produce your Pareto number for me. Go back through your trades, put them into an Excel spreadsheet, rank order them by profit size, figure out what your Pareto number is. And I've met very few. There's a couple approaches to trading that do not apply to Pareto, and that's people who are naked options. They're selling options that are not covered, hoping to collect the premium that the options will expire worthless. And when they're successful, the Pareto principle doesn't apply to them because they actually make money on most of the things they do. But the old saying that we have about people who are we call short gamma, they sell uncovered options, is they're picking up pennies, and they keep picking up pennies till they're run over by the road paver, and so that they make money every month, every day, every week, every year. They keep doing it until they lose it all. Then they're wiped out. And so that's the short gamma trader. And so, but anybody who is a flat price trader, Pareto applies to them. And I would challenge your listeners to go back over the last year, over the last 5 years of their trades, enter them into an Excel spreadsheet, run the number, figure out what their win rate is, but figure out where their Pareto level is. What percent of their trades produce their winners? And even if they're losing, even if they're struggling, they're trying to make it as a trader, they have some profitable trades along the way. But they can even figure out of their profitable trades, what's their Pareto number that's even keeping them alive. And it's still going to be the Pareto number. And so the challenge that we've come to in trading is if a trade goes profitable right away, I'm not saying that the first hour. I'm just saying that we put on a contract of we say we're going to get out if we lose half of 1% of our capital. So $2 million is our house account. If we lose $10,000, we're out of the trade. We're gone. And then as a firm, we take the approach that if by the end of the week we want to have moved our stop loss for the trade at least to the point where we're break even. That if hopefully the trade shows a profit right away, or it shows a profit within the first few days, but if after a week it still doesn't show profit, we just want to get out of the trade. We'll get out of the trade at break even. But if the trade is a profitable trade, we will stay with that trade and advance the stop of that trade based on an 8-day moving average. And so we use an 8-day moving average on half of the trade. If it's on the entire trade, if we put the trade on based on a daily chart, based on the completion of a classical chart pattern on a daily chart. In the case of London Sugar, if people want to pull up the London Sugar chart for this period of time, the beginning of September, what they'll find is that we broke out last week of what Schabacher would have referred to as a continuation inverted head and shoulders pattern. And so we have a target in mind. That's what we're looking at. We want to give London Sugar the complete ability, as long as it remains profitable, to run to the target, to move to the target. But if the price violates an 8-day moving average, we will exit half of the trade. If it violates an 18-day moving average, we're out of the other half. So we're completely out of the trade. And if at the end of the week, we want to make sure that we've moved our stops to at least guarantee, now, price steam gap through stops, obviously, but reasonably assume that we're going to at least have a break-even trade. And so it ends up that, 80% of our trades are either close to break-even or small losses, or at the worst, losses of 1% of our capital, or 100 basis points. And that we can look and say that 15% of our trades will have a profit of at least 1.5% or 2% of our capital. And so that's our goal. And to do that, we have to, the problem with some traders is they don't want to get out of losing trades because they admit defeat. But the minute they get a profit, they want to take it.
Dans un court instant, on verra quelle est la différence entre trader et investir et comment Peter considère l'opportunité du Bitcoin et des cryptos dans ses investissements. À tout de suite. After a short break, we will discuss the differences between trading and investing and how Peter considers Bitcoin in his trading activities. We'll be right back. Yeah, I was gonna ask you, because it seems even more tricky to me to take profit than putting a very firm line on the way down, 0.5% for example, and just sticking to it seems reasonable. But then when you on the upside, I find it harder to just follow the plan and just take profit gradually, or that's why I would think it's more difficult.
Yeah, well, it is. I mean, it drives you crazy, right? I mean, especially when you're in a trade and it stalls out, and you have a bit of a profit, and the market just decides that it's to chop around a little bit. It'll drive you crazy because it still hasn't reached the profit target, but it hasn't really gone back. It hasn't done what I would call. We call them popcorn trades, right? You're cooking popcorn on the stove in a kettle, in a pan, and the kernel pops, and it pops up to the top of the lid. Then it goes right back down. So we call those popcorn trades, right? They're a trade that it starts out in our favor. Maybe we're up 10 grand, 15 grand, 20 grand. But the market stalls and goes back down. And it goes back down to our break-even point, and we're out, and we've had a popcorn trade or a round tripper. And so you have to have great patience in saying, I'm going to try to hold this trade. And it's unnatural. But quite frankly, Pago, our experience is that at least in the case of discretionary, we're discretionary traders. We don't trade a system. We don't trade a computer program that is computerized to the point that it calculates our risk, that enters orders automatically, that we turn it on, we flip the switch and we watch it. That's a pure systems approach to trading. We don't have a pure systems approach to trading. We're making discretionary judgments on the trades that we enter, and once we enter a trade, that trade is generally ruled to the extent of 80% of its life based on rules or principles. We have rules. We have rules that we use to say this will determine where our stop is. This determines where we take profits. And so we're 80% rules-based once we enter, but we're still 20% discretionary. And so I think it's unnatural. Our experience is that, and we've met a lot. We know a lot of people who this is their job. They become traders. They become speculators, whether it be in gambling, whether it be in sports betting, whether it be in poker, whether it be in market speculation, whether it be in real estate speculation. I think there's a general rule that we're own worst enemy.
Yeah.
That who we are inside, our character faults, our character defects, try to emerge and do everything they can to sabotage what we do as a speculator. If we follow our urges of doubt, our urges of false hope, our urges of lack of confidence, they'll attempt to sabotage us. And so really, at the basis level, once you French know how to make great sauces out of meat juice, right? There's nobody that can make a sauce like the French can. There's nobody. But you make sauces by boiling something down to the essence. You bring it back to the essence. It's what you have left when you cook all of the bad stuff off and end up with only the good stuff. But at its essence, we try to sabotage ourselves. And so the job of a trader is to manage and try to learn who they are as people. There's nothing that'll teach somebody who they are like market speculation or gambling or sports betting. You want to know who you are, become a speculator. The good, the bad, the ugly, it all comes out, especially the ugly.
Especially the ugly. You're right. No, that's really fascinating, and I guess it's a case by case basis depending on the personality, and as you said, you learn by experience. Are there things that you would advise in terms of finding a system to push the emotions out of this? I'm thinking about. I know that you or used to say that you take positions on business close or close of business. That could be maybe a way to kind of remove all emotions from the trade. But is it true? And do you have any advice to try to keep this to because you're a professional trader. That's what you've been doing all those years. So you have to behave to put a system that you as a person maybe don't necessarily think that you need to, but you do, right?
Yeah, and that's such a great point, Huckle. Let me address the idea of discretionary trading versus systems trading, because that's really important. It takes kind of a special mentality to be a discretionary trader. And I think the road to being a systems trader may be an easier road, because to a certain degree will remove, if one follows their system, and follows it religiously and is committed to it, it is slightly easy. It's easier to remove the day-to-day emotions. And so let me talk a little bit about both, because I think they're both different paths. If you're a systems trader, you better be a coder. And one advice I give to all kids I meet is to learn how to code, learn how to do coding. If at any point in time in your life you want to learn market speculation, learn how to code. And there's a lot of programs out there for coding in market speculation. I mean, there are tons of them out there. TradingView is a trading platform used by a lot of novice traders. You can code all kinds of things there, but learn how to code. But it's just not about coding. It's about coding principles. And so if you take the principle that you want to be a systems trader, you do not want to have to use day-to-day judgment. You want to be able to code a trading system that tells you what to trade and when to trade, and how much to trade, what size to trade. Think in terms of principle, the principle of cut your losses short, let your profits run, and try to create codes that do that. Try to code that. And once you code that, give yourself a year or two of trial in the markets you plan to trade. Let's say your asset class is foreign exchange, and you want to trade the primary. In other words, Swiss franc, euro currency, Japanese yen, Australian dollar, US dollar, Canadian dollar, British pound. You want to stay with the majors. So major, or major minor, US dollar, Mexican peso, US dollar, but avoiding the exotics, Brazilian, but stay with big countries, big economies. But code something, but don't put your money into it yet. Don't jump in with real money. Spend a year or two to work through your code. Find out how your code's working. Observe what your code does, because even in the process, you'll say, I'm gonna change my code a little bit. I'm gonna modify my code a little bit. But try to get a code to the point where you think it's an implementable code for a year or two. And then after that point, put some real money behind it, because what you find is it's easy to trade paper money or hypothetical accounts. That's easy. That itself removes a lot of the emotion, doesn't it, Paco? Because if you're wrong, you're wrong. You're playing with monopoly money. But all of a sudden you have real money. You write out a check to a brokerage firm and you deposit with, with a brokerage firm or bank or forex dealer. Now you've got real money and you're implementing a real program. And, and all of a sudden emotions do come in. So it's not emotionless. If you're trading the system, it doesn't completely remove emotions, because you're watching your real money being executed, and you have to have the discipline to execute what the system says, and you may disagree with what the system says, and so you develop that. And I think the real big traders, the Renaissance of the world, the Wintons of the world, they're trading systems. The big dogs are trading pure systems that actually execute themselves. They determine a size. They enter the orders automatically. I mean, they're systematic all the way through trade implementation, and they're just monitoring the outcomes as they go. And so that's the system. Give yourself a couple of years to work through your coding, get a system that you think works, because again, you're trying to develop coding, not that's going to make $1 million the first year, but that can return 20-30% per year and compound itself to build real wealth. That's real wealth. That's not what I would call Lamborghini money. It's not a yacht on the Caribbean money. It's real money. It's real wealth. It's wealth that is transferable to a new generation. And so that takes time, and that's a big investment. Then on the discretionary side, you want to use judgment, and that's kind of more Paul Tudor Jones, it's me. There again, you want to choose your assets. You choose what asset class you want. I love futures. I'll sell futures and forex every day of the week because I love those markets. I think those are markets that are wonderful. And so, but again, you develop what it is, your rules. You develop principles. You develop rules, and you paper trade. You trade hypothetically. And you work through trading for a year or even 2 years. Don't jump in right away. Maybe it's crypto. I know a number of traders who have now transitioned pretty much purely to crypto trading. They used to trade corn in gold. Now they're trading crypto. But it's the same thing as you work through your principles for a year or two. Hypothetical, there's a lot of brokers that offer hypothetical accounts. You can trade hypothetical accounts, but you do it and you keep track of your metrics. You keep track of things like win rate, loss rate, size of average trade, expressed as a percentage of your total capital. You see people saying, I just traded Apple and I made 100% in Apple. Well, they made 100% of an options trade. So they put $2,000 into an options trade and they made $2,000. They're claiming 100% return. You can't do it that way. You always got to measure risk and reward against the total amount of money that you're using to speculate with. Mm-hmm. And so that's the real expression of performance. And so they paper trade, you keep track of Pareto, you keep track of average win, average loss, win rate, because you have to remember on win rate, even though I'm right 50% of the time, that's over a large number of trades, Paco. That's when I'm looking back and saying I've made thousands of trades. But over any individual shorter sequence of trades, you throw that out the window. That doesn't matter. Last year I had a period where out of 21 trades that I put on, 20 closed as a loser. But last year I was right 55% of the trade, but yet I had that series of 20 trades. So you do 20 trades and you have 19 that are losers. Figure it out. Let's say you're risking 3% of your capital on a trade and you go through that streak, because you will. All of a sudden your account's wiped out, but you're trading an approach that over the long term might have been possible if you didn't lose all your money. So you do that and then put real money behind it. And that's the correct way to really become a speculator, Paco.
Would you say that things, you had to adapt through all these decades of trading. You have to adapt to very changing environment. Even the trading itself is probably miles away from what it used to be. And yet you've been able to be very successful. And I remember there was a metric of profit ratio, I think, on your portfolio of 5.4, which is like world class. So very successful. Would you say that things that it is easier or harder to trade and be successful today as opposed to the time when you were trading, or there isn't any major differences?
Oh, that's such a great question. That is an awesome question. I think it's harder. And I think it's harder for a number of reasons. I think one of the reasons is if you measure volatility. I used to trade copper. I've traded copper at 60 cents a pound. Now you got copper measured $3-4 a pound. I used to trade at 60 cents a pound. And there's been years when I've traded copper that it's only had a 5 cent a pound range. Now we have 10 cent a pound range. This is in an entire day. In an hour, copper can range 10 cents a pound. And so measured in terms of that kind of volatility, that's huge. I've traded corn in years when corn for an entire year has ranged 20 cents a bushel. Now we have 20 cent ranges in a day. And so we have that kind of, it makes it harder. It makes it harder because it's easier for people who who aren't wise, who are not prudent, who are not careful, to lose money more quickly. And so that's one factor. I think another factor is high-frequency trading. It's all the algo traders. It's guys that are trading algo programs. They know, for instance, it's possible for these algo traders to buy data from the CME, Chicago Mercantile Exchange. That's the biggest futures exchange in the world. It is possible for people like Renaissance to actually have access to the bid-offer spread to the last price a millisecond before I do. And because they have their port right to the exchange. Mine has to work its way through data providers, and so what they're seeing is my trade. They're seeing my trade before I do it, and it gives them when they have enough horsepower behind their program, and a great book is the book about Renaissance trading, which is probably the most successful trading firm in the world, but they have more PhDs than most universities. And I mean, they've got Nobel Prize winners who are doing their coding. And, not some 24-year-old who's down their basement the mother's basement doing their coding on TradingView. They have PhDs and Nobel Prize winners that are doing their coding on high-speed, massive computer programs. So, and they have an advantage because they know about the trade before I knew the trade. So I used to look at trading, and I look at bid-offer spread. A market is offered at a certain price. It's bid at one tick lower. Well, if I'm going to buy a market, I always end up having to buy at the offer. I'm always paying up a tick to get in. They take the other side of that. They have the bid-offer advantage because they are the bid-offer advantage because they have prices a millisecond before I do it, and they have the computer program to take advantage of the fact that they have access to prices a millisecond beforehand. And so it's a big advantage. So I think that is, and I think it's harder today. And hey, I don't know where we were there, Paco. I probably rambled on for about 10 minutes. Then I noticed, man, Paco can hold his head so steady. I wonder if that's a French trait.
We are, as you know, very calm, very stoic, and we stay very still.
Yeah, exactly.
No.
Yeah, so I'm not sure where that ended up dropping us off.
No, you were just precisely saying that you in your opinion that things were actually harder now because obviously of what you have to stand up against, and it looks like it really feels like when you're a small fish in a big pond nowadays, and it's more difficult to make a difference. Is there any particular competitive advantage why you might have just trading his own accounts on its own basis? Or
I think there is. Yeah, I think so. And I guess we would, as traders, we'd call that as an edge, right? I mean, where's your edge? Because they're not usually huge edges. They're tiny. You find a tiny edge and you exploit it. I think for us is that we don't have the size to move in and out that a big hedge fund would have. If you're a huge $10 billion hedge fund, you don't have the ability to trade Matif corn. You don't have the ability to trade some of the markets we trade at the Singapore Exchange, which are great markets. There's some great markets in Singapore. Or move large positions into the Chinese offshore yuan or something like that. So I think the fact that we've remained small, if you're too big and you find an edge, the market is kind of a living, breathing, organic organism that will search you out and figure out you have an edge and want to take it away from you. I think it's no. I'm not saying that the market's a conscious, living, breathing enemy, but to some degree, the market senses. Markets always trade to where the orders are. If there's a lot of buy orders, markets have a tendency to go to the buy orders. The market price does not like sitting in a vacuum. Market price always wants to migrate to where orders are, where large orders are. And these modern computers have a better way to sense that than I do. So I think my edge, comes from the fact that we've remained small. We're not trading a big hedge fund. We're not trading this huge account. I think we're flexible. We're willing. I think the big edge we have is losers don't really affect us. I mean, we really don't care if we're losers in markets. I think we're good losers. I think that's really where our big advantage is we're just fine losing money. It doesn't affect us when we take a trade and we lose. Mm-hmm. You mentioned something. Markets do evolve and markets do change, and I think there is maybe some classical chart patterns that we traded successfully 30 years ago that we don't trade anymore because we found that they're disruptive. They're absolutely meaningless now. But yet I gave a speech in 1992 to the Market Technicians Association, and that's the big organization that kind of certify technical traders, whether they be systems traders or chart traders or numeric traders or whatever. You become an MTA, and it's kind of like being a lawyer or licensed practical whatever. And I gave a keynote speech to the MTA back in 1992 that I had forgotten all about, and somebody sent me a copy. There was a transcript of it, and they sent it to me, and I read it, and I got, I haven't really changed much. I've changed a lot around the edges. I've changed in terms of tactical implication, how we implement trades, how we move risk, how we do risk management. I think we changed tremendously. But in terms of foundationally trading classical charting, we're pretty much the same firm that we were 48 years ago. I mean, we're looking for rectangles and right angle triangles and head and shoulders, and we're looking for chart patterns that indicate that. And when you're there's nothing magic about a chart pattern. If you find a market like we had in London Sugar, where there was just a wonderfully formed head and shoulders that was inverted and part of the trend, wonderfully, just classically formed. I mean, I hate calling a chart pattern beautiful, but I guess in our eyes they are, right? We see a chart pattern and go, God, that's sexy. That's a sexy chart pattern. But, we see those, and it's nothing in the construction itself that's magic. I think about it, you read back through Schabacher, who started this whole thing. He was, he was the editor of Forbes magazine back in the 1920s. We're very well-respected Wall Street guy, very, very well-respected. And he was the one that made first observations on these patterns that charts tend to form when they're plotted on a graph. And I liked his thinking because it was, in his eyes, what they did is represented what the big, powerful hands were doing. The big, big movers and shakers in a market. It was a footprint. It was a footprint of what big players were doing. And that's all. It gave you a hint as to what people who probably knew more about what markets are all about than me. It was my way of kind of seeing their footprints in the sand and getting a clue upon the accumulation of positions or distribution of positions that was being taken by the powerful forces that be. And And so that's what a chart pattern is. I've just found over time, some of those patterns don't really work too much anymore. And so we become more selective on what a pattern is for us. We become extremely selective as to what we need to see in a chart. And, I think it used to be that if we follow a certain chart goal, let's say, that gold would give us 6, 7, 8 good chart signals a year, where now we're finding that a given market may only give us 1 or 2, at the outside 3 good signals a year. And again, because of the risk management we use, half of those aren't going to work.
Yeah. No, and it's funny. I mean, it's interesting because I never, I always wonder exactly what the charts meant. And I think you gave the description of a footprint really speaks, better to me in terms of what we're looking for and why we are so focused. I mean, traders are so focused on shapes, right? Of the price, which if you're not from that sector, you have a really hard time understanding why, this shape particularly means anything. But the way you were putting it, that that makes you understand what the big influences of the market are actually doing. That brought a light to me. So.
Yeah, Paco, the interesting thing is we've made our living as a firm trading chart construction, trading based on what the charts are doing. But then somebody will come to us and say, charts don't predict price. And we go, you're right, they don't. But if I go on Twitter and saying charts are meaningless, charts don't predict the future, charts, it's fighting words. And we're the firm that's made money, and we're being argued against by some guy sitting in his mom's basement thinking charts are magic. They don't. All a chart does is you look at a chart, it tells you where markets have been. It tells you where markets are right now. And it doesn't necessarily have to. It tells you at which price charts might declare themselves, where price might declare itself. That if there's going to be a sharp movement in price over a month or 2 month or 3 month period of time, a chart will show you at which price that movement will possibly declare itself. That's all a chart does. There's nothing magic. Charts don't predict the future. They don't tell you where Bitcoin's going. They tell you where Bitcoin's been. They tell you where Bitcoin's been, where it is right now, and at what price do I have an asymmetrical bet on Bitcoin? At what price in Bitcoin might I make 10,000 of Bitcoin, but only have to lose 2,000 a bit if I'm wrong? That's what charts do for me, is where do I have an asymmetrical risk on a trade rather than a binary risk. And so, for me, that kind of sums up what a chart's all about.
And you mentioned crypto just now, and so I had this question for you about why do you like Bitcoin and the big crypto? Is it because the size of the market is so small right now because adoption hasn't really happened yet, that volatility levels are really high and therefore big opportunities there as a trader? Or do you like the asset, the underlying itself, it means to you? What do you think of crypto?
I mean, there's part of me that actually is an investor in Bitcoin, right? I mean, I own Bitcoin and it's tucked away. And I've owned it for a long time. I started buying Bitcoin when it was about 400 a coin.
Wow.
And I just look at that as I've taken some profits along the way. And I just look at that as an insurance policy against the destruction of fiat currency, right? I mean, it's the global macro view of Bitcoin. I have that toward Bitcoin. I don't have that toward any of this other nonsense, altcoin, crap coins. They're all going to become worthless. But Bitcoin, because of its structure, because of how it's been accepted by big players, I think is just, it's like you take a fire insurance policy on your house, you take an auto insurance policy on your car, you take a life insurance policy on yourself. You really don't want those insurance policies to have to collect. I mean, you're hoping you never have to call your insurance company and say, my house is burnt down, I want to collect on my fire insurance. You don't want that to happen. But it could happen, and that's why you take the insurance policy. And for me, Bitcoin is a policy against the destruction of fiat currencies, whether it be U.S. dollar or euro currency or whatever, that they will lose their purchasing power over time. And if I'm not a big FOMO, fear of losing out buyer in Bitcoin, but wait and try to buy a Bitcoin at good prices, recently under $20,000 a coin, it's a good hedge. If I put a couple percentage points of my assets into that coin, it's an insurance policy for me. But other than that, it's just a trading vehicle. And as a trading vehicle, it is volatile, but it has big moves. And so I don't look at Bitcoin in terms of the way that the Bitcoin, I call them, they're not enthusiasts or addicts, the Bitcoin addicts. I don't look at it that way, that it's the measure of all things. Mm-hmm. I look at it as just another trade. I mean, it's just like me trading European corn, mm-hmm. or gold or whatever. It's a name. All it is a name and a price change, so I don't attach, on the trading side of what we do as a firm, I don't attach any special value to Bitcoin, and I'm not willing to trade the other junk, because I think the other junk will become worthless some days, and I really don't have an interest even being in a trading position in something that's going to become worthless.
So you want still underlying fundamental value and, I guess, large swings, right? Because Bitcoin offers that. Mm-hmm.
Yeah.
Yeah, and I think in your book you talk about investment versus trading, and that's also what this question is about, whether you see any difference between, investing and trading, essentially, and whether you can do both without necessarily, tainting your position or your intentions.
That is a magnificent question, Paco. I'm glad you asked for it, because that does create a conflict sometimes in my head between thinking of an asset class as an investment, something I want to hold on to. Taiwan, Microsoft, for instance, is the company in Taiwan's largest chip maker in the world. I've owned that in retirement accounts. And so the mentality that I have to do either in Bitcoin or in accounts that are designated by my government as my pension account or retirement account, which are not actively traded, they tend to be old positions for a long period of time. And what I do day to day as a business, they can be in conflict to another, and that can create some emotional conflict as well. And so it's a high wire act. You're on a wire connected to two big buildings with a big pole, and you're trying to balance those two. And one side of your brain is yelling. It's like being inside your head is a board meeting, and everybody's shouting. And I have to purposely kind of sometimes say, I'm going to go on a bike ride, or I'm going to go take a walk, because I've got these two people in my head that are fighting with each other. If I need to create some order, right? I need to say, okay, guys, state your case, and let's find an amiable solution. And so it's something that you have to work at, and I think for that, investors need to understand that you don't do investing and speculating with the same account. You don't have an account with some European forex dealer, and on one hand you're trading something long term, and on the other hand you're day trading, because it can create all kinds of problems. You don't do that with the same account. In fact, you probably don't want to even do that with 2 accounts with the same broker. You want to have this account over here and this account over here, and you need to not be trying to make decisions for both accounts at the same time. And for me, for instance, my solution against being caught up with the emotion of a trade is we have a couple of company policies. One company policy is we never take a trade out that we haven't seen in advance the weekend before. And so I'm not going to all of a sudden on a Wednesday have some market come to my attention and say, I think we're going to take a position. We're not allowed to. It's just a rule. We cannot do that. And the other thing we do, even on positions that we're holding, and we're not holding much right now, but on the positions we're holding, we have the policy that we make decisions at the end of the day. We have stops in. Those stops work. They're good till canceled orders. But if we're going to change those stops or we're going to change those targets, we can't do it intraday. We have to wait for markets to close up. And so for us, that's 4 in the afternoon. Is we make decisions between 4 and 5 in the afternoon. We make changes to orders between 4 and 5 in the afternoon. We create our master orders on Sunday afternoon that kind of cover the whole week. And, again, we modify those after markets close as we go through a week, but we make decisions separate from the excitement of a market. So I think the worst thing individuals can do if they're starting out is actually to watch price monitors during the day. I think that's just counterproductive. Go find something to do, become a gardener, or, help out, volunteer at the local hospital, or, work at the nursery for mothers who want to have a job. Do things like that. Get away from the markets. Get away from prices. Don't be, pulling out your phone and you've got TradingView on there, your brokerage account, and you're looking at your account value 5 minutes every day. That's counterproductive. It will draw upon the worst of who you are as a person. It'll breed all kinds of negative emotions that are counterproductive to long-term success. So learn to separate yourself from price discovery as far as you can. Make decisions away from price discovery where you can do so on a more rational basis, not get caught up in the excitement. And that's why, even looking at the failure rate and success rate of novices who come in, the failure rate for somebody who wants to day trade is about twice as what it is for somebody who's willing to sit with positions. And it is just a terrible rate. 1-2% of people who day trade actually can become career day traders. And, but of course, everybody who does that say, well, I'm of the 1 to 2%. I'm going to defy the odds, right? Everyone thinks they're going to defy the odds, which in fact they're not going to. And then when they do, they're going to blame it on somebody else. It's like I love Bitcoin. When Bitcoin goes up, it's destiny. When Bitcoin goes down, it's a conspiracy. People who love gold and silver, it's the same thing. When gold goes up, it's destiny. When gold goes down, the banks are manipulating price. That's the world we live in. So
absolutely no, and the human brain has a way to find stories that accommodates where it wants to go. That is just unbelievable. No, it's very good advice about the emotions out and not trading during the day. I find it very, very savvy and interesting. I just have one last question because I know you've been very generous with your time, Peter. One thing that struck me when I was reading your book as well is what I was thinking. What a lonely, solitary situation must it have been for you as a trader, because I picture myself as a trader not necessarily communicating with anybody in a way that in the market kind of you're not really colleague. And you work in a firm, you can to talk about your issues with your colleagues. When you're in the market, you are playing the other person, and it's just you in the market and your mind. How, what advice or could you maybe give to persons who are kind of going to walk into that journey of what it seems to be very solitary, a very lonely position?
Yeah. I had a big advantage there, Paco, because I spent the first 6 years of my career at the Chicago Board of Trade. And, and that was back in the day of pit trading, right? So I worked in a building filled with pretty much successful traders. I mean, if you weren't successful at the Board of Trade, you didn't stay around long. You were gone. I rode the elevators with these guys. I stood next to them on the floor. I ate lunch with them. I rode the train to the suburbs with them. And I think, and so I was in community. To a certain degree, I was in community, right? But the benefit to me was not, what do you think of corn? What do you think of gold? Where do you think soybeans are going to go? What do you think of IBM? It was in the guys to me that were the most important influence were guys that shared with me stuff dealing with your head, not where market's going to go. Everyone goes and they're looking for magic on Twitter. They're looking for some magic, somebody to some guru to follow. And because they're looking for what do I buy and when, and that's not where the game is played. The game is won or lost based on, how you deal with the emotions in the process of trading. And so the guys that had the most influence on me were guys that would tell me stuff such as, you really have no idea what a market's going to do. You're clueless. The guy that was the biggest mentor to me used to say, you want to be out of all your losing positions on Friday. Never take a loser home on Friday. You want to have a clear head on the weekend. You want to be able to enjoy your weekend. You don't want to sit there if you have a corn position on in July, worried about whether it's going to rain in Iowa on Sunday. You don't want that. You don't want the burden. You don't want that hanging around your neck. You want to be fresh. Don't pay attention to markets during the day. Turn off your machine. Go find something to do. That's the best advice you have to people. And so, but now it's lonely. Now, fortunately, I have a staff. Now we have a deal where, we had our offices in Colorado. Well, now I'm in Minnesota. I'm in Arizona. The person who really runs the operations of the company was in Colorado. They moved to Milwaukee, Wisconsin, and we have one of the guys that do analysis. Our operations are kind of run out of New York in terms of computer and finances, and we have a trader in Bulgaria, and that does analysis for us. So we're spread out that way. But yet, when you trade, that's an individual decision. It's not a group decision. It's not coming out of a committee. I'm not looking at memos. I'm making a decision and I'm having to stick with it. And so in that degree, it's lonely. And I really feel for the people who are coming into it now. They're fresh. Because while I spent 6 years in exchange with other traders, people coming into it now, they're all alone. But there's a danger that they're all alone because they seek community. And they purposely reach out for community, and they get involved with online communities. And online communities can be super dangerous, because you're paying attention and you don't really know who in that community actually is sharing real wisdom and who's sharing a bunch of BS.
Mm.
And so, on that community, you got some guy who's bragging about his last 3 trades, and now you're interested in what his next trade is. Well, that's his trade. It's not your trade. It's somebody else's trade. And so you have to be extremely discerning if you're all alone, reaching out to online communities, because more often than not, it's a community that's not going to lead you to wonderful things. It's a community that, if you're not careful, is giving you negative advice, not positive advice. So, yeah, it's a lonely business, and it's something that somebody has to recognize if they're looking to have their back slapped and having people tell them how great they are. And it's not the business to be in.
Okay. Yeah, well, at least people here are going to be warned now. That's very clear. Peter, thank you very, very, very much for your time and your insights. It's been very helpful and incredible advice. Is there any resources that you would point people to beyond, obviously, the education that you provide with the Factor and your book? Is there any other place you would point to in terms of resources?
Yeah, I think there's some books that I don't like how-to books. I think how-to grade books are extremely dangerous. There's some books by an author named Mark Douglas that are very good because they tend to deal with the hand, right? It's how do you manage your hand? And then there's just books that, in general, there's a book by Nate Silver, and I'm just trying to think of the exact name, but it's Signals and Noise, Why Most Predictions Fail. And Nate Silver is an extremely well-known U.S. statistician, and it goes through why most predictions don't work. Even most predictions about the economy, about how bad PhDs in economics are at predicting what the U.S. economy is going to do, for goodness sakes. They have a terrible record. And so I think that's a good book to read. And so I'm not in favor of kind of the how-to book. Here's a magic signal that you can get with candlestick patterns, or the way to use point and figure charts, and the latest and greatest set of things to do with the bar chart. I'm not big on those because I believe that everybody, when you read the one thing is the Market Wizard series by Jack Schwager. What a great resource that is, because Jack Schwager, a wonderful guy, he has interviewed, I don't know what the latest number is, 55 of the best traders in the world. The best traders in the world. He's interviewed extensively. And I'm in one of the Market Wizards books, and I know how extensive he is. You have to show him your trading records. The interview takes place over numerous days. It's in-depth. And, Jack really does his research on who he's going to talk to. And he has literally talked to the best there is, and he's condensed it. And through these Market Wizards book, you read through there, and there's 2 messages that come out loud and clear from these guys. First, it's about risk management. Risk management, risk management, risk management, risk management. You're a risk manager as a trader. The second one is you've got to find your own way. Is that through looking at all these traders, they're not two that do things alike. They follow their own niche. They've found something that works for them, that's compatible with how they think, is compatible with how their mind is compatible with who they are. And so you got to find your own way. You got to find your own formula, so to speak. And they all come across it. So there's great wisdom in the Jack Schwager Market Wizards books. So I highly recommend them. But, people send me books because they want me to write a good thing about them. And generally I stick them in a box and they're in the garage. And very, very, very few get read. So read books about trading, but read books about the psychology of trading. You can't be enough of a statistician. you've got to know random probability. Books that deal with random probability of outcomes, extremely good. Be a good mathematician if you're a trader. Be a good self-psychologist. Be a good random statistician. Understand statistics. Understand probability theory. So books on that. Other than that, I'm not big on recommending the how-to secret ways to read a chart. That's up for each individual to discover.
No, but you provided already quite a fine list already. I find, and interesting that all these the discipline you just mentioned as being good assets for a trader. Clearly, completely far away from the image that we had from the trader.
Yeah.
Like it's easy rolling on a big car and just snapping fingers and the trade is done. So very a realistic, down to earth. Super helpful view of what it actually is to be trader.
Well, thanks, Paco. I've really enjoyed our time. I want to greet all you French investors, traders. I don't travel much anymore. My body really doesn't allow me to travel much. I'm pretty much confined to certain smaller spaces, except when I'm on my electric bike. And I doubt that I'm going to bring my electric bike to France. So, if I ever get there, I'll let you know, and would love to have a gathering. I am in contact. I am in contact. What I do is I do write-ups on my trades. And so, journaling for me is important. I'm not recommending journaling to everybody, but for me, I think by writing. Right, I think by writing out and saying, here's sugar, here's what it's doing, here's London sugar, here's why I like London sugar more than number 11 New York sugar, here's the pattern, here's what it's telling me, here's where I would get in, here's where I think it's going to go, here's the risk I take. So I do all of this. Now, part of my staff's job is to write it up and make that available to, and so that's the business side. I'm on the trading side of the business. There's others that take that and repackage that information and make it available. They can, figure out kind of what all our company does on, serving members. I think we have 1,800 people in 66 different countries that can monitor what I'm doing in my own account. But even then, I say, don't matter what I'm doing in my account. It's not what I'm doing in my account that's important. It's the emotions I'm going through. It's the process. It's the process by which I trade. That's what you pay attention to, is risk management. Pay attention to that. Follow my losers, not my winners, because you'll make better. You'll learn more by understanding losses than by understanding winners. So, but they can, follow me on Twitter at Peter Brandt, because I tweet a lot. So I guess that's my community. I mean, if you talk about who I share my life with, it's this stupid world of Twitter. I mean, it's this crazy Twitter world. What a crazy world that is. I mean, it's a nutty world, So I'll put something out there why I think I put something out there why I think you want to own the sugar contract in London sugar denominated in U.S. dollars worth $50 a tick, and I'll have 2 people say, I'd like the trade. Now, 20 people say, you're insane, old man. Hey, old dinosaur, when are you going to retire? So, that's the world of Twitter, right?
That makes for a lively conversation, indeed. Yes.
Yeah.
No.
So, Pago, let's do this again sometime.
Absolutely. Anytime. And really, really happy to share your prospects, your ideas with the audience, the community in France. Obviously, I mean, you're probably going to get some more replies now in French or with slightly a different syntax, English syntax in the messages.
Yeah. Well, I'll enjoy it. As a matter of fact, Google Translator is great because I will translate anything I get in a foreign language, and I'll try to respond the best can, right?
Perfect.
But the syntax of Google Translator English into French can pretty much bastardize anything I want to say, right? But at least I try, to send a couple maybe in another language. I try to reach out, which I think is the mistake Americans make, is they just expect everybody in the world to understand English when, in fact, there's no language more beautiful than French.
Oh, thank you very much.
And, I that's one of the things I enjoy about French. And, I have a French music channel on my Pandora. I don't know if you have Pandora over there, which is a music you can select varieties. I have a French one. I just love the music. I don't understand the words. I just love the music.
Okay.
So French food, French music, French people.
Well,
I embrace them all.
that's perfect. You are destined to speak to us then. That's perfect. Thank you very much, Peter. Thanks a lot.
Thanks, Paco. And I just click leave and I'm gone. Best of luck to you.
Thank you.
Great talking to you.
Yes, likewise. I'm very honored to have you. Thank you, Peter.
Bye-bye.
Voilà, c'est tout pour aujourd'hui. J'espère que cet épisode t'a plu. Faites-toi un investisseur un peu mieux informé. Si c'est le cas, n'hésite pas à partager ce podcast avec ton entourage et à lui mettre une évaluation 5 étoiles sur Apple Podcasts ou Podchaser. Ça permet de le faire monter dans les classements et de me donner la motivation pour t'offrir toujours le meilleur contenu. Voilà, merci beaucoup encore pour ton soutien et une très bonne fin de semaine à toi. Ciao!